Hello there, I'm Aaronade. You are watching Boom Bust, coming to you live from New York City, and these are some of the global financial stories impacting your world today. Now, first up, we're looking at the banking industry in the U.S. today. Now, the bankers themselves, they might be rolling in the dough, but the books of the big banks, they tell a very different story. I'll explain all of that coming right up. Then the founder of Global Macro Investor and Real Vision TV joins us live from the Cayman Islands to talk about the markets and the state of the macro economy. And in today's Big Deal, Edward Harrison and I are talking about the big numbers, big business, and big payouts behind the NCAA's March Madness tournament. Time now to get to it. Today we're talking banking, and when you talk about banking in the United States, you simply gotta talk about JP Morgan. Jamie Dimon, JP Morgan's CEO, has vowed to fight the Fed over capital requirements for the big banks. And as we all know, the Fed is upping the amount of capital that the biggest banks must have on their balance sheets in order to create a safe cushion for the next crash. Now, the Fed's tougher capital rules give the mega banks an incentive to shrink, but Dimon has no intention of doing that. And that's because if you purely look at just the numbers, a lot of the shrinkage in the banking industry is because the industry as a whole isn't doing great. Citigroup's return on equity, or ROE, was the hardest hit at the time of the financial crisis, and the bank nearly collapsed. In fact, Citi's ROE only became positive in 2010. Citigroup's stock currently trades at a discount to book value of 28%. Now, what that means is that their book value is higher than what they actually trade at in the market. So basically, what they have on their books isn't what the market sees them being worth. And Bank of America's price-to-book ratio is about the same as Citi's, so Citi's not alone in this predicament here. Now, the average price-to-book ratio for equity holdings in the SPDR ETF is 1.37. By comparison, that's almost double the price-to-book that you'd have at Citi. Mind you, the SPDR ETF is a proxy for the whole universe of American large-cap stocks. So why are Citi and other big banks trading at such low price-to-book ratios? That's the big question, and the answer is because their business isn't doing that well. Now, critics argue that enormous banks have an unfair advantage because everyone knows the government deems them systemically important and wouldn't dare let them default. Not only that, they are also able to borrow more cheaply than smaller competitors. But in spite of this, they still have a problem with their returns to investors. The Fed doesn't order banks to downsize. It simply requires that the big, complicated ones have more capital than the smaller, less complicated ones. But none of this is to say that the big banks are secure in any way. And that's because size isn't their only issue, or possibly even their main one. The problem with financial regulation is that some of the most important issues are the hardest to understand. So bottom line, there is no silver bullet to fixing this problem. And if and when we have another financial crisis, we'll just have to wait and see if these big firms aid or exacerbate that crisis. To get his insight on markets, Raoul Pal is back on the show. Raoul is the founder of Global Macro Investor and Real Vision TV. Real Vision is an online subscription-based business news network, and I asked Raoul what type of person or audience benefits the most from the content on Real Vision TV. Take a look at what he had to say.
Well, I guess we set it up really to offer kind of in-depth financial information for everybody. So it's not just for the experts, but it's for people who kind of don't trust financial information as they see it portrayed in most of the media. So it's basically from anybody who manages their 401k through to the RIA networks, through to the average man in the street, along with the market professionals as well. There's kind of something for everyone there.
Now, you mentioned someone just managing their 401k, but can you give me a real-world example of how Real Vision can help the non-finance guru, the normal, non-technical subscriber, essentially?
Yeah, I think it's to understand how broad things in the world can impact their portfolios. So to understand, for example, how the dollar, a strong dollar may impact the oil price, because many people have investments in the oil market, just by owning a few shares here and there. It gives them a better understanding of some of the risks that they have, or what it means when the Federal Reserve are trying to raise interest rates or trying to cut back on quantitative easing, and how that might affect their portfolio. So it kind of affects everybody.
Now, I saw your interview with Albert Edwards, and I wanted to ask you about his view. Now, he's sometimes described as a perma-bear because of his ice age call on equities, but he sounds just as bond bullish as he does bond bearish. So what is your takeaway from the macro picture he paints?
See, Albert, it's unfortunate that people call him a perma-bear because they don't understand that what he's doing is making a choice between various asset classes, and he's less optimistic on equities than he has been on bonds, and that's been exactly right. Since he made the call back in 1996, bonds have outperformed equities over that entire period. So you need to understand what he's trying to do, and he's asset allocating. And he doesn't do it just because he wants to be sensationalist. In fact, that interview that we did with him on Real Vision was the first one in 20 years that he'd done on television. The reality is that he has a consistent and considered framework that he bases his ideas on.
So how can one express that view in terms of asset allocation or investment selection? What do you think?
Well, I think, it depends on people's risk appetite and how they view the world. But his view has been right, and it's my view too, that the bond market has still a good place in your portfolio. It may get riskier in due course, but generally in a disinflationary or deflationary environment, you need to own some bonds. So for the average guy to own one of the kind of bond ETFs makes total sense as a part of their portfolio mix, and much more than you're ordinarily told to keep as part of your mix.
Now, interest rates, they continue to fall everywhere, Raoul. And this is even in the wake of the Fed's March meeting, in which it said rates are going up sometime this year, and U.S. long-term rates are now lower than they were before the Fed meeting. So what the heck is going on here?
Well, I think the market is telling us, and I firmly believe it to be the case, that the Fed cannot raise rates. If every single central bank around the world pretty much is cutting rates, and the Fed are trying to say that they can raise rates, whether it's to have new bullets ready for the next recession when it comes, or whatever reason, the bond market's saying it cannot happen because you will slow the economy. And if we look at the Q1 GDP, it looks like it's already coming close to 1% or lower.
So do you think this period of lowflation, aka lowflation, that helps keep bond yields low is a secular phenomenon, or is this temporary?
It's a secular phenomenon driven by demographics and the debt burden. And the lower interest rates become, the more people get kind of trapped into having to hold their money in money markets. It becomes a really hard position to get out of. It's the trap of having low interest rates. And I think the less and less interest rates, the lower and lower interest rates remain, the worse it gets. And we've seen that in Japan. It's not like this was a surprise to us. Everybody looked at the US situation and the global situation and understood Japan, said this is going to happen again, and it did.
So what are the biggest takeaways for the non-markets person about what's going on with inflation, bond yields, fixed income investing in dealing with their own portfolio?
Yeah, I think if you say, okay, well, I noticed that the oil price has fallen a lot and many commodity prices have, and I know that inflation is very low and people around the world are cutting interest rates, then the chances are that bonds will do particularly well. And therefore, maybe you should up your allocation to some of the bond funds that I mentioned before, to the ETFs, for example, a very straightforward way of doing it. And I think that will help protect them against some of the issues that disinflation or deflation may cause within the equity market, which is much more strongly valued and is very kind of overly optimistic in its view going forwards. So I think if you would do that, you would probably balance up the risks in your portfolio much better than they are now.
And what impact are negative rates in Europe having on currencies via portfolio rebalancing?
Yeah, I mean, negative interest rates is obviously something none of us know how to deal with yet. We're all trying to get our heads around the idea. But generally, it cannot be good for a currency to have negative interest rates. And therefore, it's part of this whole kind of, you can call it currency wars, you can call it what you like, but it basically is everybody wants to have a cheaper currency to help them get their way out of the economic situation they're in. Now, obviously, everybody doing it at the same time doesn't help, The US is the only country that's not really doing it right now, and that means obviously their currency is getting stronger.
Now, my colleague Edward, he talks about Australia, Canada, and New Zealand as interest rate outliers, and he thinks this cannot last. But my question is, where are the policy rates set by central banks in those countries going to be headed? Where do you think they're going to go?
Well, if you understand what's happening to the commodity boom, which is turning to bust, that commodity super cycle, as we called it before, well, we've got the commodity super bust that seems to be underway right now. Now, look at the countries who are most prevalent, who benefited the most: Canada, Australia, New Zealand, etc. There's many more countries to that list. But that alone will cause a big problem within growth in those countries, and that's going to mean we're going to see disinflation, deflation, and lower interest rates across the board in those countries. So I think, and also we may see problems with the housing markets that got very effervescent based on the fact that there was so much money sloshing around from the commodity boom.
Time now for a very quick break, but stick around because when we return, Boom Bust's very own Bianca Fascini will be on the show. Bianca is bringing us a full report on the biggest business news of the past month. And no, I am not talking about the Federal Reserve's FOMC minutes, but the NCAA's March Madness tournament. And remember, you can always see all segments featured in today's show on YouTube at youtube.com/BoomBustRT and also on Hulu at hulu.com/boom-bust. Now, as we head to break, here are your closing numbers of the bell. Come on back with us.
I think the shutdown's pathetic, Larry. We shouldn't have to pay taxes then, should we?
Good idea, Jesse.
But have no fear, because the billionaire oligarchs are here.
What if there were a country in which the government operated outside of constitutional rule?
40% of the food that we produce in the country never makes it into our mouths.
How much fallout do you think this is going to create for the CIA?
Do you think this is what's triggering the crisis?
America's the largest economy in the world. It's also the largest debtor nation in the history of the world.
I need to know what to be terrified of. There is nothing scarier than not knowing what to freak out about.
One minute they were working toward the American dream, the next they were just trying to survive the night. It's time for Americans and lawmakers in Washington to wake up and start talking about the real causes of poverty in America.
On in your city, in your streets, never back down like Tyrell, and the truth is what you seek. To analyze, investigate from the bottom to the top. You speak your mind like Sean Stone, whether they like it or not. I got Tabitha, Miss Wallace, with the wisdom and the pearl. Between the outrage and the evidence, what's going on in this world?
Watching the hawks, watching the hawks, watching the hawks. Listen when they talk.
Welcome back to the show. Now, the NCAA has been taking heat for claiming that they can't afford to pay student athletes despite pulling in tons of money from games and tournaments. Now, it's inspired a class action lawsuit and encouraged players, economists, and even President Obama to give their take on the state of play. Boom Bust producer Bianca Fascini tells us more.
As March Madness continues, the debate over paying student athletes has been rekindled. The sports tournament is second only to NFL playoffs in ratings and generates over $1 billion in ad revenue. In 2013, the top 10 schools in college sports pulled in an average of $117.7 million. As you can see, a majority of that revenue was spent on salaries for coaches and their staff, as well as new buildings. The smallest fraction went towards scholarships for the players, but not all of those are full scholarships. And keep in mind, that money disappears if you get injured. Opponents claim the student athletes aren't employees of the university and therefore shouldn't be paid. There's also a question about how paying student athletes would overall change the atmosphere on campus. But it's also true that the players, in addition to getting an education, are the main force behind athletic programs that bring in millions of dollars per year for their schools. We've heard previously from some NCAA officials like Oliver Luck, who said paying the players would be detrimental to the whole concept of intercollegiate athletics. And Clemson football coach Dabo Swinney, who argued that there's just too much entitlement in this world and letting his players somehow make a profit would make that worse. But now more people are speaking up about changing the system. Even President Obama weighed in, expressing the issues he has with a number of NCAA policies.
What does frustrate me is where I see coaches getting paid millions of dollars, athletic directors getting paid millions of dollars, the NCAA making huge amounts of money, and then some kid gets a tattoo or gets a free use of a car, and suddenly they're banished. Yeah. That's not fair. In terms of
considering the NCAA is a nonprofit organization, it might be time to reconsider how they handle their millions. Reporting in Washington, Bianca Ficini, RT.
Now, Edward Harris and I will discuss this a little bit further in today's Big Deal. But first, it's defining moments. And now we're showing you the best comments made by our guests from this past week. So take a look at what they had to say on China's economy, the ECB, Greece, the Fed, and much more.
I mean, I have maybe about 15–20% of my money for my clients there. Most of it's in insurance companies, though. There are their own issues there because you have too much surplus in the industry. Still, they're not that expensive. But the companies are soundly managed. And banks. They have, if the economy does begin to take off, there's room for businesses to take on more debt. There are things that they could do, but so about 20% of our assets are there, and that's a reasonable place to be. Can it continue on forever that way? Well, we got over levered in 2005, 2006, 2007, but it's not as bad right now.
The Chinese economy is certainly losing momentum. Now, the official figures are always a little difficult to interpret, but what is the reality is that investment growth has powered growth in China for the last few years. And investment growth, especially residential investment, is cooling off quite a bit because there is still a lot of excess supply in certain parts of the housing market. Now, the government has set in place a growth target of 7%. I have no doubt that they can achieve this target because they have enough room in terms of fiscal policy, monetary policy. But the big question is how they get there. If they get there once again by ramping up investment, that's not going to be so good for the long run because that could mean more excess capacity in some industries that already have excess capacity. What they should be using more effectively is fiscal policy. And the latest meeting of the government a few days ago did suggest that they're going to shift towards a fiscal policy in order to boost domestic demand. And domestic demand has to be where the answer is because certainly the world economy is not going to be able to absorb much exports from China.
It's very diffused, and you're seeing it also with the election results, whether it was Le Pen's party, they got, what, 25% of the vote, they expected more. Well, you saw it with the Podemos party recently elections this past Sunday and in Spain, and they didn't come in as strongly as they thought. You saw the waning of power in Italy with the Five-Star Movement, Beppe Grillo's party, and the Syriza party in Greece. It's not doing what they said they were going to do when they got elected in fighting the austerity measures. So the pressure is there, but the organization lacks. But when you look at the fundamentals of how many people are really unhappy with this, I believe it's going to take a spark, something to ignite the people in a way they haven't been ignited before. But right now, it's a flat line of descent.
I have to say that I think both sides have handled this pretty clumsily. I think the Greek side has in its defense the fact this is a very new government and a very inexperienced government, and so can be excused for perhaps not being the most sophisticated of negotiators. But the German side has, in my view, also been incredibly crass. I'm not speaking here about Mrs. Merkel, who I think is concerned about her finance minister's very, very aggressive attacks on the Greek. But then having said that, it's clear also The German politicians are very uneasy about what's happening and are very hostile to Greece. And I heard today that the Belgians have started saying that a Greek exit would do no harm to the euro. I think that is complacent. And I think people are being very narrow in their interests. But, you know, we need wise heads here. We need experienced heads. We need heads that can emerge from an ideological morass, if you like, and provide some good, sound leadership. And there is an absence of sound leadership. Mrs. Merkel is a safe pair of hands, but she is not out front there leading the sustainability of the euro. Mr. Draghi can't play that role, and nor can the bureaucrats in Brussels play that role. So there is a great vacuum there.
Several times in the last year and a half, this issue of raising rates has been raised and come to the point where there's serious speculation that the Federal Reserve might do it. Two interesting things about that. First, every time that has happened, the stock market has taken a sharp downward plunge, letting everybody know that people whose lives depend on investing money know that the so-called recovery is very weak and very fragile, and that anything that could disturb it, like raising the cost of borrowing money for a house, or borrowing money for a car, or borrowing money for your child's education, anything that makes that more expensive, which a raising of the interest rate will do, could shatter this recovery and plunge us down. The second thing to remember is that the real pressure to raise interest rates is not about the economy being healthy enough. The real pressure comes from people who are rightly concerned about the vast amount of extra money pumped into the economy by the Federal Reserve over the last 6 or 7 years, and great fear that if that money starts to run after goods and services, we will have an inflation the likes of which we may never have seen before.
It's big deal time with the wonderful Edward Harrison, and today we're talking sports because we like to mix it up a little, and it's March, which means it's NCAA March Madness time. So Ed, college sports, it's big, big business. In fact, a lot of people think that the college games, they're more exciting to watch than pro games, and this isn't just for basketball, but also football and some other sports. So how much money are we talking about here?
We're talking about $1 billion, you know, March Madness. You know, it was interesting here. I saw something that was a breakdown of where the money's actually coming from. And it's amazing that actually the NCAA tournament produces 84% of the money. So the tournament alone is where things are happening. Now, another interesting facet was there was a graph that we don't have, but it shows that 20 years ago, in 1995, the NCAA only had $250 million. Now it's gone up 4 times in the last 20 years. That's an amazing increase in the amount of money that people are making off of these student athletes.
It's absolutely amazing. It actually blows my mind that, you know, four-time increase in 20 years. There's very few things that would ever see that sort of increase. But, you know, these college players, they're students, and we can't forget that. So they see none of the money, the $1 billion that's going in. And I mean, I understand that they can even lose their scholarship for signing autographs for money. Is that correct?
Right, exactly. So the point is they're supposed to be amateurs, and the substance is that they can't sign autographs on jerseys and so forth. We've seen people actually lose their scholarships, as you were saying, over just minor infractions of that nature.
It's unbelievable to me. And, you know, this whole kind of arrangement, it strikes me as a wee bit dodgy and dishonest, to say the least. And there's also a big class action court battle going on that highlights this very issue. So can you tell me a little bit about what's going on with the Ed O'Banion et al. Versus NCAA Electronic Arts and Collegiate Licensing Company? That's the name of that.
Yeah, so Electronic Arts has this game out, and as it turns out, Ed O'Banion's in the game. Now, you may not remember Ed O'Banion, but he was the #9 draft pick in the 1995 draft. He did 2 years in the NBA, and he was a journeyman across the world for 8 more years, didn't earn a ton of money. Now he's selling cars for a living. But as it turns out, the NCAA and Electronic Arts are making tons of money from his image in a video game that's going on. Now, there are a bunch of other people who got none of this money as well, who are the former college athletes, and they're like, wait a minute, this isn't right, we want to sue, and so they're suing, and what we've seen so far from the lower court is that they actually have won. They're not actually going to get money, but in the future, college players will they could get up to their scholarship plus $5,000 a year as compensation that is legitimate given their use of their rights, their image rights.
That's really unbelievable to me. I have to say that, not that my opinion matters in any of this or in any of these court cases, but if you're going to use someone's image and then not pay them for it, that seems like a total violation to me, particularly when they're out of college. You know, it's one thing if they're in school, I can see why the NCAA doesn't want to muddy the waters, but that's amazing. And I understand that John Oliver, the comedian over at HBO, he's on the case. I think we have a clip, so let's roll this.
You'll get to enjoy all the fun of being screamed at by a middle-aged millionaire while living in constant fear of losing your scholarship, be it from a career-ending injury, accidentally accepting a free lunch when you're hungry, or directly profiting in any way from the value of your work. Because making money's utterly antithetical to the whole principle of collegiate athletics.
There you go. Isn't that totally how it is, right?
Brilliant, brilliant. And, you know, I love Oliver, and some would say that it's kind of sad that Americans, they now get, you know, real news from comedy shows like Oliver's. I am not one of those people. I'm totally comfortable with it. But what do you think?
I think that it is kind of sad that we get news. I mean, actually, John Oliver is on this issue in a much better way. And that video, that was hilarious in a very bad, you know, sad kind of way. But it's totally what's going on, you know? I mean, game over for these guys. But, you know, $1 billion for the NCAA.
It's so true. And, you know, I have to say that there's a part of me that thinks it's really good that comedy shows that reach more people, you know, people who would watch standard nightly news or other media might not watch a comedian. But, excuse me, they might not watch a comedian, but if they watch a comedian, they might not watch the news. This way you're covering more ground if you're packaging it like this, which is why I kind of feel comfortable with it. Because if it is the truth, why not get it out there? And why not make it funny? Life is short. But, you know, I have another question for you. The Final Four, it's this weekend, Ed. So who is in that tournament? Right? Next weekend. Clearly, I haven't been watching. But who's in next weekend's tournament?
Oh, you know who's going to win is Kentucky, and I'll tell you why. Because their star, who has the most points per game, his first name is Aaron, and his last name is Harrison. So that's how it has to be.
I am so rooting
and they're
for
undefeated.
Kentucky now. Really? Yes. Okay. Look at how much we're learning. And this has been really fun. Love talking sports with you. We'll do it more. That's all the time we have for now, though. But thank you for watching, and please remember to drop us a line on Twitter @AaronAid, @EdwardNH, or on Facebook. From all of us here at Boom Buzz, have a wonderful weekend. See you next time. Ciao.